Welcome to this Killik Explains finance video. This week, a key concept for growth investors, in fairness, a key concept for all investors, payback. So let's explain that one. In a nutshell, here's the problem. A key question for firms and investors is a very simple one. How fast will I get my money back? Because risk is tied up with that concept. The longer it takes, the greater the risk of something going wrong and you never being repaid. So consistent payback suggests good management. And as an investor, consistent payback is a kind of safety net. Now, how does it work? Well, it does roughly what it says on the tin. So it compares the annual expected returns on a project, on an investment, to your initial outlay. You can basically express it as a time period in, say, months or more typically years. Example coming up. It can be calculated using profits or cash flow. The reason cash flow is in green is because I personally prefer working with cash flows, harder to manipulate and so on. And it can be done on an undiscounted or a discounted basis. Now, in a low interest rate environment, you might say, let's do the easy one, let's not discount. But actually, taking account of a firm's cost of capital is important here as it is elsewhere. So let's look at those in a bit more detail. A basic example. A cinema group is planning a refurbishment of the big new site, costing 8 million. So there's the initial outflow. With the following expected cash inflows, and there they all are, what's the payback period? Undiscounted. Now, simple example. So the money goes out straight away, £8 million in brackets there, and then it starts coming back in again down here as we start selling tickets, customers fill up the building, merchandising, popcorn, all that good stuff. So basically, we've got a growth period here. So we get £400,000 back in year one, £900,000 back in year two, 1.6 million in year three, and then we get into a kind of steady state, full capacity, 1.8 million from year four onwards. So how long would it take to get to break even in cash flow terms and get our £8 million back, if you like? Well, basically all you do to get to the answer, which is out there on the right, is you start deducting the revenue from the 8 million until you get to 8 million. So knock off £400,000, nope, we haven't got our money back yet. Knock off 900, nope, haven't got it back yet. Knock off 1.6 million, well, that's better, but still we haven't recovered 8 million. Knock off another 1.8, not quite there yet, another 1.8, almost there. Somewhere in here, we get to pay back. And it's actually 5 years and 10 months. Now, why is that useful? Well, that tells you how long you are committed in terms of having cash out there, if you like, invested in this project, and you could compare it to things like what? Previous paybacks on other projects, paybacks on projects currently running, for example, expectations from management, and of course, other cinema operators. How long does it take them to pay back on a newly refurbished site? So quite a useful number, but not perfect in this example. Why not? Because really, we ought to just recognise that the £8 million goes out now, but those inflows actually take place in the future. And that means we're not comparing apples with apples. In other words, we need to adjust those inflows for the time value of money. Now, how are we going to do that? Very simple example. Same group, same refurbishment, same cost. What's the payback period if their cost of capital is 5%? So, what is that? Cover it in more detail in other videos. Quick summary here. That is basically the minimum hurdle rate any investor would demand for putting money into this business. So it's the company's project hurdle rate too. Now, applying that to the same problem, how's it all look? Well, the initial cash outflow is still there, all the inflows are still there, but these are not discounted, all right? So I'm going to assume the £8 million goes out now, so that stays as £8 million, even applying a 5% discount rate, because we haven't applied it yet, and then we start to bring down the value of these future cash flows by applying a 5% discount rate. So for anyone wondering, all I've done is to take the 400,000 and divide it by 1.05, then 1.05 times 1.05, and so on. In other words, I've pre-baked a load of discount factors. Now that's less important than what it does to the payback period here, which is this. It stretches it out, because those future cash flows are worth less. It takes us longer to recover the 8 million to 6 years and 11 months. And that is arguably the harder calculation, but the better one to do. It's more realistic in terms of when you get your money back, comparing apples with apples. Now, I think I've solved this one already, but why is this popular? Well, let's just recap it here. So it's easy to calculate, especially the undiscounted version. It's relatively easy to understand. When do I get my money back? We can all understand that one. It focuses management on the importance of cash flow. So if they know that investors are measuring payback it gets them focused on when will I at least be able to say we got our money back on this project, and it's relatively hard to manipulate, especially if you do the cash flow version. It's not impossible, but it's relatively hard. However, why can you not just take payback away and say, right, well, that is my way of assessing an investment? Because by itself, it's got limitations. And they are what? It takes no account of scale. If I tell you you've got a payback period of 2 years on one project, 10 years on the other, all right, the 2-year project might be tiny and the 10-year project might be enormous. Does that mean you take the 2-year project? Not necessarily. It ignores later cash flows. So I tell you the project pays back in 5 years. Great, but what about a project where there's a big cash inflow in 8 years' time? Payback doesn't care about that. It stops when the money's come in, if you like. It focuses on the return of your investment, so it's kind of a conservative measure, some would say, rather than the return on your investment. So I might tell you one project's got to pay back at 5 years, another project's got to pay back at 10. You're thinking, I'll take the 5. Then I say, actually, the return on investment on the longer project is 20% a year, only 15 on the shorter one. Now which one do you want? No right answer to that, but worth thinking about. And finally, the discount rate is always subjective. Discount rates have to be estimated, they vary from company to company, they can change over time, but nonetheless, to get an accurate handle on payback, you ought to discount future cash flows. Big topic. Any questions, editor@killik.com. And if you're wondering about that stuff about discount rates, cost of capital, how I did those calculations, please go to killik.com/learn and the Investing Principles tab.